Hey there, it's Chris Richards with the Richards Mortgage Group. Today I'm going to do a little video on mortgages as they relate to pre-retirement planning, sort of for the 50 plus crowd. We just want to know what are the mortgage options available once you're retired, and what are the mortgages available prior to retirement, and what are some of the considerations that you might want to make. So why is this important? As you approach retirement, or you're considering relocating, maybe downsizing, it's imperative, in my opinion, to position yourself to retain access to your home equity as a financial tool, because once you become unemployed, your lending options are drastically reduced and the equity that you currently have in your home becomes trapped. So in the lending world, the river splits based on whether you're employed or whether you're unemployed. So there's what's called employment or income-based lending, and then there is what's called equity-based lending. Once you become unemployed, the only option you really have is equity-based lending. What does that mean? It means, what is your house worth? What do you owe on it? And can you borrow on that difference, which is the remaining equity? And lenders have caps on how much money that they'll actually lend. The challenge with equity-based lending is it's more expensive than with income-based lending that you can get while you're still employed. So let's talk first about your options once you are unemployed or retired. Generally, you can still borrow money against your home or as a mortgage if you have some sort of income. So if I have somebody with perhaps a pension income, generally you could borrow maybe 4 times your annual income, which might not be a lot. That's with a traditional mortgage, and even if you get that mortgage in place, you're going to have a mortgage payment. So let's contrast that to a reverse mortgage. A reverse mortgage is an equity-based lending product where the amount of money that you borrow, you have no payment on that. And every month, the interest that accrues is added to the balance that you owe. So it's a compounding balance. Interest just keeps growing. And as a result, in the reverse mortgage space, the lenders will base your original loan on your age. When you're 55, you have a lot more years likely ahead of you than, let's say, when you're 85 years old. So you can borrow a lot more money if you're seeking a reverse mortgage once you're 85 years old. At the 55 range, 55 years old, you might only be able to borrow, say, 15% of the value of your property. So for easy math, if you have $1 million property that's $150,000, you could borrow at the age of 55. Whereas if you're 85, you might be able to borrow half of that. So what's attractive about a reverse mortgage? And by the way, these mortgages are fully regulated by the Canadian government. They're not some crackpot offering you money. They're well regulated. There is competition for reverse mortgages. So competition means that there's rate competition, there's fee competition. So with a reverse mortgage, you don't have to make a monthly payment. So I'm talking to a client right now. He wants to purchase a home. In fact, you can purchase a home with a reverse mortgage. He is buying an $800,000 property on Vancouver Island. He's got a $200,000 he wants to put as down. $200,000 he needs to borrow, and $600,000 he's going to put as his down payment. That $200,000 that he's borrowing, under the reverse mortgage scenario, he does not have to make a payment. His balance is just going to increase over time. Now, why the reverse mortgage strategy works for lenders is because home values also appreciate over time. And I've done the math. If you actually look at how much a home is appreciating and how much your balance is growing, the difference between those two numbers is staying relatively constant. And that's why that product exists. So ultimately, when you move out of your property under a reverse mortgage scenario, actually under any mortgage scenario, if you sell your property, the reverse mortgage gets paid out from the sale proceeds. There should still be a significant amount of money left over if you're looking to pass that to a family member. So the real attraction for reverse mortgages is there is no payment. You can receive a lump sum money up front or in chunks, or you can receive a monthly amount if you're looking for it to supplement your other income sources. The reason that people might need access to equity after retirement is maybe the home needs repair, maybe a water line breaks, maybe it needs a new furnace, maybe it needs a new roof, maybe you have a vehicle that needs replacing. There's a lot of unforeseen things that come up. So that's the advantage, or reverse mortgage in a nutshell, is you don't have to make a payment. You can spend your money elsewhere. So coming back to reverse mortgage or loan options available for people as they approach retirement, the whole point there is, how do you create access to your equity? So going back to the reverse mortgage option, that's available after you've quit employment. You need to be at least 55 years old. The youngest person in the house has to be at least 55 years old. So as you approach retirement, one of the other things to do is what I call positioning yourself so that you can access your equity after retirement. So you have a few different mortgage products available to you there. You have a HELOC, which is a home equity line of credit. It gets added on to your existing mortgage, or if you don't have a mortgage, it just sits on your property. With a HELOC, home equity line of credit, you can access money, you can pay it back, access money, pay it back. There is what's called a second mortgage. Second mortgage is where your original mortgage is in place and you need some more money. So there are certain lenders and private lenders who will give you a chunk of money and they'll tack it on in second position behind the mortgage, let's say with RBC in first position. And that will typically come with a higher interest rate. And of course, you've got the payment on the regular mortgage and you still have the payment on the second mortgage. So we've talked about mortgage products for people who have retired, and largely that's a reverse mortgage, or you can get just an equity loan at a higher rate and you need to pay that back. The reverse mortgage you don't need to. Then we've talked about while you're still employed, you have more options. And so as you approach transition in your life to the cottage or downsizing or whatever, while you're still employed, my favorite product is what's called a ReAdvanceable Mortgage or a re-advanceable line of credit. And that's different than a HELOC. And the reason why it's different is when you pay down a re-advanceable mortgage, when you pay down that mortgage amount, the home equity line of credit limit is increasing by exactly the amount of money you pay down every month. So personally, I have this on my house. As I have aggressively paid down my mortgage, I know I'm not losing access to my equity. And that's really important to me and my wife as we think about retirement, is that we can still write a check on the equity if we needed to repair the roof, help a child with a down payment, buy an investment property, buy a vacation property in Costa Rica, whatever the needs are. We have ready access to the equity in our property, which we put in place while we were still working. Let's just talk quickly about the rates and setup costs between reverse mortgages, lines of credit, etc. So with traditional bank lending, anytime you get a mortgage or a line of credit secured against your property, you're going to need to have a lawyer involved. You're going to need a property appraisal. You'll need income proof for a mortgage or a line of credit. As it relates to a reverse mortgage, you're still going to need a lawyer involved, appraisal cost as well. And typically on the reverse mortgage product, they have a incremental legal advice called a certificate of independent legal advice, and that's there to protect the borrower, gets the borrower in a room alone with a lawyer without kids present, without pressure, to make sure that mom or dad are entering into this reverse mortgage strategy with full understanding of what's going on. Interest rates on a reverse mortgage are about 1.5% to 2% more expensive than an equivalent traditional mortgage on a house if you had the ability to income qualify. For the HELOCs, whether a home equity line of credit, whether a standalone HELOC on your property or part of the ReAdvanceable Mortgage bundle are typically priced at prime rate plus 0.5%. So if prime rate is, say, 2.45%, then 2.95% you have to make an interest-only payment. Now consider a scenario where you have a HELOC on your property that is open rate relative to what the bank prime rate is doing. So right now, when I'm filming this, the rates are quite low. If rates increase, you will be exposed to an increasing payment amount. So that's called interest rate exposure. One of the things, most HELOCs don't have any ability to manage that interest rate exposure. It's a variable price, a variable interest rate, and that's what you have to pay. One of the ReAdvanceable mortgage products I have actually has the ability to look at the balance within the home equity line of credit and say, I want to lock in $100,000 of that balance into an amortizing fixed rate mortgage. And so as rates might continue to rise, you can lock in what your payment is on the fixed rate component. And so that's a really important feature to manage interest rate exposure, interest rate risk, is theoretically for using a ReAdvanceable mortgage. One of my ReAdvanceable mortgage suppliers who offers this ability to lock in rate over time, you can actually synthesize a reverse mortgage with this ReAdvanceable product. You simply advance on your line of credit over time and then convert that to a fixed rate, and then you continue to pay that down. The payment that you're paying down re-advances to your line of credit, and so you can keep going up to a certain point. When you run out of limit, you can keep accessing your home equity. Now, that can be a dangerous strategy if you don't know what you're doing with your money or you're short on money. The reality is that if you run out of limit and you can no longer make your payments, you're going to have to sell the home, as opposed with the reverse mortgage strategy where it's difficult to get into that kind of problem. So to conclude this video, I was just trying to bring out what are the mortgage options as people approach their retirement years or once they're in retirement. I talked about that once you become unemployed, your lending options become very limited, whereas if you're still employed, you have the opportunity to get a home equity line of credit, or my favorite, the ReAdvanceable mortgage line of credit product, which will give you a lot of flexibility to maneuver as you go into transition into your retirement. Flexibility in so many ways. I get very excited about that particular product. But you have to set that up while you're still employed, while you're still making good money. That ReAdvanceable mortgage can stay in place even after you have retired, because there's no need to requalify. The risk on a ReAdvanceable mortgage, however, if you get into some sort of credit difficulty or your credit rating takes a tumble, they can actually pull that product or reduce your access or remove your access to your line of credit. If that were the case, reverse mortgage would still be an option for you. As I mentioned, with the ReAdvanceable mortgage, why I like it also is it encourages the borrower to aggressively pay down their mortgage without losing access to your equity, and you just don't get that in a regular mortgage product. You put the money into the mortgage, it's a black hole. You're not going to see that money again until you either sell the property or refinance and do an equity takeout with a lump of money. So your home equity is a huge financial tool. I also want to point out that the amount of equity you can access in a HELOC or ReAdvanceable mortgage while you're still employed is massive compared to the reverse mortgage strategy. You can access somewhere between 65 and 80% of your property's value while you're still employed if your income supports it. Whereas if you get into the reverse mortgage, it'll be age dependent, somewhere between say 15 and 45 or 50% of your property value. Simply having that standby access available to your equity, irrespective of whether you ever use it, perhaps you have enough pension, you have enough CPP, you've got enough in your RRSPs to fund your lifestyle. But just simply knowing that you've got that cash or access to your equity just in case you need it, that's a very comforting thought. It's really important to have a conversation with a person who understands tax, understands how to access the equity, knows what the options are before, and have that conversation well in advance of needing the access to the capital, because sometimes it's too late by the time you ask the question. So I hope this video has been useful. This is Chris Richards with the Richards Mortgage Group. Please feel free to reach out if you'd like to have an in-depth consultation on your situation.